Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
You know, you hear about someone selling their small business, and it sounds straightforward, right? Find a buyer, sign the papers, cash the check.
Yeah, seems easy on the surface.
But the reality is, so many deals stumble when it comes to financing. The buyer might be perfect, but getting a traditional bank loan these days can feel like, I don't know, trying to scale a glass wall.
Oh, absolutely. It's a huge hurdle. But what if the answer was actually sitting right across the table, with the seller?
Okay.
That's the fascinating territory we're exploring today. Seller financing, where the business owner selling up essentially becomes the lender for the buyer, is far more common than you might think.
Really? More common?
Yeah, we're talking about a significant chunk of small business sales. Estimates suggest anywhere from 70 to a whopping 90% involves some form of seller financing.
Whoa, 70 to 90%. Okay, let's unpack this. That's not just a niche thing then. It's like a major part of how small businesses actually change hands. So for you listening, whether you're a business owner eyeing that next chapter and, considering selling, or just someone curious about the nuts and bolts of business deals, our deep dive today is all about understanding seller financing as a really strategic tool. And we're going to be laser focused on the tax advantages it can offer you, the seller.
Right. We've sifted through a wealth of information, from the insights of business brokers who see these deals day in and day out to the perspectives of financial services companies, all to bring you the most valuable takeaways.
And in this conversation, we're going to break down the core mechanics of how seller financing actually works, the clear benefits it can bring to the table, and there are quite a few beyond just getting the deal done. And of course, we'll touch on any potential pitfalls. But like we said, our main lens today is how this can be a really smart move when it comes to managing your taxes as a seller.
So whether you're actively drawing up your exit strategy or just like to be in the know about alternative finance methods, yeah, you're in the right place.
All right, so let's get right to it. For anyone who's maybe scratching their head, what exactly is seller financing in simple terms?
At its core, it's really quite a direct arrangement. Seller financing happens when the person selling their business provides a loan to the buyer to cover a portion of the agreed-upon purchase price.
Okay.
So instead of the buyer going to a bank, the seller steps into that role for a piece of the funding. You might also hear it called owner financing, a seller carryback, or even a purchase money mortgage. Different terms, but the same fundamental idea.
So the seller becomes the bank. That cuts out the whole process of applying for a traditional loan, right?
Yeah, actually. It bypasses the often time-consuming and sometimes frustrating process of a buyer trying to secure financing from a traditional lender. What's interesting is that sellers typically finance somewhere between 5 and even up to 60% of the business's selling price.
Wow, 60%. That's a lot.
It is. That wide range really depends on a lot of factors, like the seller's comfort level with risk, how much of their own equity the buyer's putting in, and the overall structure of the deal.
That's a significant spread. So in most cases, the buyer still needs to bring some of their own money to the table or find other ways to finance the rest?
Precisely, yeah. It's common for buyers to combine seller financing with their own cash, maybe loans from friends or family, or even a smaller traditional loan to cover the full purchase price.
Okay.
And here's where it gets really interesting. A seller's willingness to offer financing can send a really powerful message to potential buyers.
Oh, yeah. Like what kind of message? That they're easier to work with or something?
Well, it goes deeper than that.
Oh.
It can signal a real belief in the ongoing success of the business.
Oh, makes sense.
Think about it. If you're willing to finance a portion of the sale, it suggests you're confident that the business will continue to generate revenue, which is,
right.
What the buyer will use to pay you back.
Right.
It's almost like the seller putting their money where their mouth is, telling buyers, I believe in this business so much, I'll bankroll you myself.
Yeah.
Conversely, some buyers might view a seller's reluctance to offer any financing as a potential red flag, making them wonder if the seller has doubts about the business's future.
That makes total sense. Okay, so we've got a good handle on what seller financing is. Now, let's really dig into why a seller would choose to do this. Beyond just getting a deal done that might otherwise fall apart, What are the direct benefits for the seller? And let's keep that spotlight firmly on the tax advantages.
Absolutely. There are several really compelling reasons why a seller might decide to offer financing. One of the first is that sellers who offer financing often achieve a higher overall selling price compared to those who insist on an all-cash deal.
A higher price. Okay.
Yeah, we're talking about the potential to receive a noticeably higher percentage of your asking price. The logic is that buyers may be willing to pay a premium because of the flexibility and accessibility that seller financing provides. It just makes the acquisition more feasible for them.
So the very act of offering financing becomes a kind of value add that justifies a higher price. That's a smart way to look at it. What's another key benefit?
Another significant advantage is the creation of an income stream. Instead of receiving one large lump sum when the deal closes, the seller receives payments over time, which can be much more strategic for long-term financial planning.
Right, like steady income.
Exactly. Think of it as building your own reliable income stream, almost like setting up your own personal pension. And the interest rates on seller finance deals can often be quite attractive, typically ranging anywhere from 6 to 10%.
That's pretty good.
In many cases, that's a better return than you might get from more traditional savings accounts or lower risk investments. So the interest earned really adds up over the life of the loan.
Okay, a potentially higher sale price and a consistent income stream with good interest, those are definitely strong incentives. But let's get to what we really want to unpack, the tax advantages. How does seller financing affect the tax man?
Okay, this is where it can get really beneficial for the seller. The primary tax advantage of seller financing is the ability to spread out the capital gains taxes over time as you receive the payments.
Okay.
Instead of potentially facing a significant tax bill all in one go after an all-cash sale, the tax burden is stretched out over the period of the loan. This can potentially lower your overall tax liability in any single year and maybe even keep you in a lower tax bracket.
So it's all about avoiding that big tax hit in one fell swoop.
Precisely. Imagine an all-cash sale. You recognize the entire capital gain in that tax year. That could really sting.
Ouch. Yeah.
With seller financing, you only recognize the capital gain proportionally as you receive the principal payments from the buyer. It's like you're only paying tax on the profit you've actually received in that specific year.
Yeah. Can you give us a more concrete idea of how that works with an example, maybe some numbers?
Absolutely. Let's say you sell your business for $1 million and your original investment or your basis in the business was $200,000.
Okay.
If the buyer paid you the full $1 million in cash, you'd have a capital gain of $800,000 in that year, and you'd owe capital gains tax on that entire amount. Pretty hefty.
Right.
Now let's consider seller financing. Say the buyer pays you $900,000 in cash at closing, and you finance the remaining $100,000 with a 5-year note.
Okay, so $100K financed.
Right. In this scenario, your $200,000 basis is allocated proportionally between the cash payment and the installment note. So a larger portion of your basis is applied to the $900,000 cash you receive up front.
Got it.
And the remaining portion of your basis is applied to the $100,000 note. You only recognize the capital gain associated with each payment as you receive it over those 5 years.
I see.
It's like dividing a pie. Your initial investment is the whole pie, and with seller financing, you're only taxed on the profit from the slices you receive each year.
Okay, so it's not just delaying the tax, but it's a more gradual recognition of the profit for tax purposes. That makes sense.
Exactly. And it's important to remember that while the capital gain portion of the payments is taxed at capital gains rates, the interest income you earn on the loan is taxed as ordinary income, just like your salary or wages.
Right. Ordinary income rates on the interest. Got it.
Also, for those interested in the specifics, this ability to defer capital gains taxes in installment sales, like seller financing, is covered under Section 453 of the Internal Revenue Code.
Section 453. Okay.
Essentially, this part of the tax code gives sellers the green light to spread out their tax bill when they finance the sale themselves.
That sounds like a really significant advantage for managing your tax obligations. Beyond the tax benefits, what other positives are there for a seller considering this?
Well, as we touched on earlier, offering seller financing can really broaden the pool of potential buyers.
Right. More people can potentially afford it.
Exactly. There might be many individuals who are keen to buy a business, but simply don't qualify for a traditional bank loan or don't have the liquid funds for a large all-cash purchase. By offering financing, you're essentially opening the door to a wider range of opportunities and increasing your chances of finding the right buyer.
More potential buyers usually means more offers and maybe even a quicker sale. Yeah.
Precisely. Seller financing can often lead to faster closing times because you're bypassing the often lengthy and complex approval processes of traditional lenders. You, as the seller, are in control of the financing decision.
True.
Additionally, for some sellers, there's a real opportunity to provide mentorship and ensure a smoother transition for the buyer. This can be particularly important if you've poured your heart and soul into building the business and you care about its future success and legacy.
That's a good point.
And, as we've discussed, your willingness to finance a portion of the sale demonstrates your confidence in the business's continued viability, which can be very reassuring to the buyer.
So it's not just about the financial aspects. There can be a sense of ensuring a good handover as well. Now, we've looked at the upside. What are the potential downsides or risks that a seller needs to be really aware of before offering seller financing?
This is a critical area for any seller to carefully consider. The most significant risk is the potential for the buyer to default on their loan payments.
Yeah, that's the big one.
If this happens, the seller might have to go through the difficult and potentially costly process of taking the business back, which, can be a real headache. So the seller is essentially taking on the credit risk of the buyer.
Nobody wants to go through the process of reclaiming a business. So the seller really needs to vet the buyer thoroughly, like really thoroughly.
Absolutely. Another important consideration is that the seller doesn't receive the full amount of the sale price up front.
Right. Delayed cash.
Instead, it's paid out over the term of the loan. This might not be ideal if the seller needs a large sum of money immediately for other investments or, personal expenses.
True. Depends on their situation.
There's also the potential for some ongoing involvement with the business, especially if the seller feels the need to monitor the buyer's performance to ensure the loan is being repaid according to the agreed terms. So it might not always be a completely clean break.
Right. The seller still has a vested interest in the business's success until the loan is fully repaid. You're kind of tied to it still.
Exactly. And this really underscores the importance of conducting thorough due diligence on the buyer's financial capacity, their business experience, and their overall track record. The seller needs to feel confident that the buyer has the skills and the resources to operate the business successfully and make those loan payments consistently. Furthermore, it's absolutely crucial to have a well-structured promissory note and a comprehensive security agreement in place. Very important.
What exactly do those documents cover? What's in the fine print?
Well, the promissory note is the formal IOU. It outlines all the key terms of the loan, the agreed-upon interest rate, the schedule for repayments, what constitutes a default, and the remedies available to the seller in case of default.
Okay, the core loan terms.
Right. The security agreement gives the seller a legal claim on specific assets of the business as collateral in case the buyer defaults on the loan. This can include tangible assets like equipment and inventory, and even intangible assets like the business's name and goodwill.
So collateral.
Yes. Sellers might also want to consider obtaining a personal guarantee from the buyer, which means the buyer's personal assets could be at risk if the business fails to meet its loan obligations.
Oh, a personal guarantee. That adds teeth.
It does. Additionally, filing a UCC-1 statement provides public notice that the seller has a security interest in the specified business assets. Think of it like registering your claim, so other potential creditors are aware of your stake if things go south.
Okay.
These legal safeguards are absolutely essential to protect the seller's interests. You can't skip this stuff.
So it's definitely a lot more involved than just agreeing on a price and a monthly payment. There's real legal structure needed. Now, let's briefly touch on how seller financing typically fits in with other ways a buyer might finance a business acquisition. We mentioned SBA loans earlier.
Yes, seller financing is often used in conjunction with other funding sources. For example, a buyer might obtain a small business acquisition loan from a bank and then use seller financing to bridge the gap and cover the remaining portion of the purchase price.
Makes sense. Combined funding.
When SBA loans are involved, there are often specific rules and requirements regarding seller financing. The SBA typically requires the buyer to inject their own equity into the deal, often around 10% of the total project cost. Seller financing can sometimes be structured to fulfill part or all of this equity requirement.
Okay.
However, the SBA often imposes what's called a standby period on the seller note, particularly if it's being used to cover the entire equity injection.
A standby period. What does that mean for the seller? Sounds like waiting.
It pretty much is. A full standby period essentially means that for a certain initial period, often 1 to 2 years, the seller cannot receive any principal or interest payments on their loan.
Wow. No payments at all.
for that initial period, potentially.
Yeah.
And their loan is subordinated to the SBA loan, meaning the SBA gets paid back first in case of any financial difficulties.
So the SBA is first in line.
Always. In some situations, a partial standby arrangement might be possible where the buyer can pay interest on the seller note during this period, but the principal payments are still deferred and the seller's loan remains secondary to the SBA's.
Okay, a little better maybe.
These SBA regulations can be quite intricate and can vary depending on the specific SBA program and the lender involved, so it's absolutely crucial to seek expert advice if an SBA loan is part of the financing mix.
Yeah.
Imagine the bank wants to be the first in line to get paid. During the standby, even if the buyer's making money, you as the seller might have to wait before receiving payments on your loan.
Definitely sounds like a lot of interconnected pieces there. Something to watch out for. Now, we've been really focused on seller financing as a tax strategy, which is our main topic today. But we did mention briefly that there are other tax considerations in mergers and acquisitions. Can you touch on any of those briefly while keeping our focus on the benefits for the seller in a small business sale?
Yes, while our primary focus today is on the significant tax advantages of seller financing for the sellers, specifically that ability to spread out those capital gains, it's worth noting that the broader tax landscape in M&A is indeed complex. There are strategies like Section 338, which can impact how a buyer treats the acquisition for tax purposes, and Section 197, which deals with how intangible assets are amortized. These primarily affect the buyer, but can indirectly influence the attractiveness and structure of your deal.
Okay, more for the buyer side, but good to know. And what about Section 1202 that we mentioned earlier? Is that relevant here?
Ah, yes. Section 1202. The qualified small business stock exclusion. Look, this can offer a really substantial tax benefit by allowing the exclusion of capital gains on the sale of qualified small business stock. However,
Big however.
it's absolutely critical to understand that this applies specifically to the sale of stock in qualified C corporations.
C Corp only.
Right, and it comes with a very specific set of requirements related to the type of business, the company's asset limits at the time the stock was issued, and, crucially, how long the seller held the stock, usually 5 years.
Okay, lots of conditions.
Exactly. So this is a distinct and separate tax benefit related to selling stock in a qualifying corporation. It's not directly tied to the mechanism of seller financing the overall business sale itself, which, can involve various business structures like LLCs or S-Corp, where Section 1202 wouldn't apply at all.
Got it.
So while potentially a huge benefit in the right circumstances, it's a different tax strategy than the one we've been primarily discussing with seller financing. Important distinction.
Okay, great clarification. So, while Section 1202 could be a fantastic outcome for some sellers, it's a different avenue than the tax advantages inherent in the seller financing structure itself. Now, as we begin to wrap up this deep dive, what is the single most crucial piece of advice you would give to anyone listening who is contemplating seller financing, whether they're on the selling or the buying side?
Without a shadow of a doubt, the most critical piece of advice is to consult with a qualified tax advisor. Period.
Yeah, can't stress that enough.
Our discussion today provides a general overview of the concepts and potential benefits, but every single business sale and every individual's financial situation is unique. A seasoned tax professional can provide personalized guidance tailored specifically to your circumstances, helping you fully understand the tax implications, structure the deal in the most tax-efficient way possible, and ensure you're in full compliance with all relevant tax laws, which, as we know, can be intricate and are always subject to change.
Similarly, engaging experienced legal counsel is absolutely essential to properly draft and review all the necessary legal documents, that promissory note, the security agreement, everything, ensuring your interests are fully protected throughout the process. Don't DIY this.
Couldn't agree more.
Yeah.
Professional advice is key. This has been an incredibly insightful look into the world of seller financing. So just to quickly recap some of the key takeaways for you, the listener, seller financing can indeed be a really powerful tool when you're considering selling your small business. It has the potential to attract a wider range of buyers, could lead to a higher overall sale price, and, crucially for our focus today, offers significant tax advantages through the ability to strategically spread out your capital gains tax obligations over time.
However, it's equally vital to be fully aware of and carefully consider the potential risks involved, most notably the risk of the buyer defaulting on the loan.
Right.
And the fact that you won't have immediate access to the entire sale proceeds up front. You need to be okay with that delayed payout. So as a seller, it really boils down to carefully weighing those potential benefits against the inherent risks and making absolutely sure you conduct thorough due diligence on the buyer and have all the necessary legal and financial safeguards firmly in place.
Absolutely. And for you, the listener, I'd encourage you to really consider this. Given the potential for significant tax deferral and the increased flexibility it can offer in structuring a sale, could offering seller financing be the key to unlocking the next chapter for your business?
Good question to ponder.
And if it could, what would be the very first steps you would need to take to explore this further with your trusted financial and legal advisors?
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.